Free numbers. 56.77% of the world's central bank reserves. 89.2% of all foreign exchange trades. 58.83% of global cross-border payments by value. All three of those numbers describe the same currency, the US dollar. Not the biggest economy in the world by share of global GDP, the US is around 25% of that. Not the most populous country, not the largest exporter. But somehow, the dollar sits on one side of almost every serious financial transaction on the planet. This video is about the actual mechanics behind that, the history, the infrastructure, and the data, not opinions about whether it's good or bad. The dollar's dominance wasn't inevitable, it was built through two specific historical decisions. In July 1944, representatives from 44 Allied nations met in Bretton Woods, New Hampshire, and agreed to a new global monetary system. Currencies would be pegged to the US dollar, and the dollar itself would be convertible to gold at a fixed rate. This made the dollar the anchor of the entire post-war financial system. That gold link broke in August 1971, when President Nixon suspended dollar-to-gold convertibility, an event now known as the Nixon Shock. In theory, this should have weakened the dollar's role. Instead, a second arrangement filled the gap. Through the 1970s, the US negotiated agreements with Saudi Arabia and other oil producers to price oil exclusively in dollars, in exchange for security guarantees. This became known as the petrodollar system, and it meant that any country buying oil, which was, and still is, almost every country, needed dollars to do it. The first pillar is reserve currency status. Central banks around the world hold foreign exchange reserves, assets they can use to defend their own currency, pay for imports, or service foreign debt during a crisis. According to the IMF's currency composition of official foreign exchange reserves data, the US dollar made up 56.77% of all allocated global reserves in the fourth quarter of 2025. The euro was a distant second at just over 20%. The Chinese renminbi, despite China's economic size, held less than 2%. That dollar share has declined from a peak of about 71% in 2000, and this decline gets a lot of media attention as evidence of de-dollarization. But recent research from the National Bureau of Economic Research found that most of that decline is explained by exchange rate valuation effects and the growth of gold and smaller currencies in reserve portfolios, not by central banks actively dumping dollar-denominated assets in favor of a specific rival currency. The second pillar is even more dominant. According to the Bank for International Settlements 2025 Triennial Survey, the most comprehensive study of global currency markets, conducted every 3 years across more than 1,100 banks in 52 jurisdictions, the US dollar was on one side of 89.2% of all foreign exchange trades in April 2025, out of a market trading $9.6 trillion per day. This is what economists call a vehicle currency. If a company in Indonesia needs to pay a supplier in Brazil, it's often cheaper and more liquid to convert Indonesian rupiah to US dollars, and then dollars to Brazilian real, rather than trading rupiah directly for real. The dollar acts as the common intermediary, not because of any rule, but because that's where the deepest liquidity already exists, which in turn keeps liquidity concentrated there. It's a self-reinforcing loop. The third pillar is the plumbing of international trade itself. SWIFT, the messaging network that banks use to process cross-border payments, tracks currency usage across roughly 11,000 financial institutions in more than 200 countries. As of January 2026, the US dollar accounted for 58.83% of global payment value on that network. The euro was second at 13.54%. The Chinese renminbi, despite years of internationalization efforts, sat at just 2.42%, and SWIFT data through late 2025 actually showed the renminbi losing ground in both global and international payment share, not gaining it. This matters because reserve status is somewhat abstract, but payment infrastructure is operational. Every day, real companies settling real trade invoices default to dollars, because that's what their banks, their counterparties, and their existing systems are built around. This dominance comes with a benefit French officials in the 1960s famously called an exorbitant privilege, because global demand for dollars and dollar-denominated U.S. Treasury bonds is so deep, the U.S. government and American companies can borrow more cheaply than they otherwise would, and the U.S. can run persistent trade deficits without the currency crises that would cripple most other countries doing the same. But it's not free. Economist Robert Triffin identified the tension back in 1960, now called the Triffin Dilemma. For the rest of the world to have enough dollars to conduct trade and hold as reserves, the U.S. has to run persistent deficits, sending more dollars out than it takes in. Over decades, that structurally pushes the U.S. toward being a net debtor to the rest of the world, a direct trade-off for the privilege of issuing the world's primary reserve currency. None of this means the dollar's position is permanently fixed. Reserve share has genuinely fallen from 71% to under 57% since 2000, a real, measurable trend. Central banks have diversified into gold, into smaller currencies like the Australian and Canadian dollar, and a handful of countries have signed bilateral trade agreements settled in local currencies rather than dollars. But the data doesn't support the more dramatic version of the de-dollarization narrative, a rapid handoff to the renminbi or any single rival currency. China's own capital controls, the lack of a fully open bond market, and limited legal transparency make the renminbi structurally difficult to hold as a reserve asset at scale, regardless of China's trade volume. What the data shows is a slow, multi-decade diversification away from a dollar monopoly, not toward a new dominant currency, but toward a more fragmented, multi-currency system that still has the dollar at its center. The dollar doesn't dominate the global economy because of a single law, a single agreement, or a single country's willpower. It dominates because of decades of compounding infrastructure, reserve holdings, trading liquidity, and payment networks, where each pillar reinforces the other two. That's also exactly why it's so hard to replace. A rival currency doesn't just need a big economy behind it, it needs deep, liquid, trusted markets that took the dollar half a century to build. Until another currency clears that bar, the numbers say the dollar isn't just winning the game. It still largely is the game.